Order blocks are often seen as key zones to spot trade setups, but have you ever wondered why certain order blocks play out perfectly, while others seem to be completely disregarded by the market? We ran several tests using different criteria to check if they actually improve the success rate of order blocks, and the outcome gave us some valuable insights. What we found is that order blocks tend to perform well only when specific repeating behaviors occur within the market. So in this video, we'll start by breaking down the core rules and walk you through a straightforward strategy for trading order blocks, along with showing you the backtesting outcomes. Next, we'll dive into the specific conditions that make order blocks more reliable, and how you can boost your win rate using these filters. So if that's the kind of content you're into, make sure to hit the like button to support us, and if you're new here, don't forget to subscribe, as we regularly share advanced trading. So first, let's go over some of the key principles behind order blocks and smart money concepts. In simple terms, we identify the final candle that leads to market imbalance as the order block zone, because we assume that this is the point where major decisions were made by smart money. At times, order blocks are located right at the beginning of a strong impulsive move. And in some cases, they appear mid-move as a candle that can either match or contrast the color of the trend. We follow three main rules to spot a valid order block. The first rule is that it must cause inefficiency. Inefficiency happens when a sharp price movement creates visible gaps between the wicks. Here are some examples showing the difference between efficient and inefficient price moves. Second, it should result in a break of structure or a shift in character. A break of structure or change of character is the initial sign that the market is revealing its intention, either to maintain the current direction or to reverse. Third, it needs to be unmitigated. Order blocks are considered single-use zones, so we only look for trade setups the first time price revisits the order block. Looking at the 15-minute chart of the euro-dollar, let's identify the order blocks starting from the left. These zones show clear signs of inefficiency on the chart, so we highlight the candles that caused the imbalance as our order blocks, but only if they resulted in a break of structure or a shift in character. Based on our criteria, all of these qualify as valid order blocks. Now, let me walk you through the steps of the trading strategy we applied during the backtesting of these order blocks. The rules for this trade setup are straightforward. First, find a valid order block. Then, set your entry at the start of the order block zone, and place your stop loss at the opposite end. For profits, we aim for a target that's twice the size of the stop loss. With this approach, even a 34% win rate keeps us at break-even. Now let me walk you through the conditions needed to spot a high-quality order block. But before we move forward, as always, hit that like button to show your support us, and if you're new here, don't forget to subscribe. This video took our team a lot of time to put together. Also, if you've got any questions, drop them in the comments. We do our best to respond to everyone. The key elements to focus on when trading order blocks fall into four main categories: market structure, market volatility and spread, market trends, and confirmation from recent order blocks on lower timeframes. Let's begin with market structure. I'll show you some of the most frequent patterns that occur on a daily basis. In this case, we have a valid order block along with a possible long setup. However, if we look to the left, we can clearly see a gap between the candles directly beneath the first order block, along with another valid order block zone in that area. This increases the likelihood that price will dip down to fill the gap, collect liquidity below the first order block, and then move upward after tapping into the second order block. So when this formation appears, with a gap and a valid order block right underneath the first, we assign a -1 point to the first order block for trade evaluation. Also, keep in mind that a break below the initial order block doesn't always indicate a trend reversal, since it could just be a liquidity grab setting up the next major move. On the other hand, check out this second pattern. Here, we have a valid order block, and when we examine the left side, we can see that the move has cleared the liquidity sitting below these equal lows, a sign that could support upcoming price action. So, when this kind of setup appears, where an order block captures liquidity below or above equal lows or highs, we assign it a +1 point for trade consideration. The third pattern closely resembles the second one. Picture an order block ahead of price action. As the market approaches this level, it forms a support zone, where many retail traders place their stop-loss orders just below. This increases the probability that price will sweep the liquidity under those equal lows before continuing upward into the order block zone. Now, let me walk you through a few real chart examples to illustrate this concept. Here we have the euro-dollar on the 1-hour time frame. We can identify this valid order block, which created an inefficiency and a break of structure. But if we look to the left, we can also see a support level that's rejected price multiple times, indicating a buildup of liquidity just below. Additionally, there are gaps directly beneath this zone, along with another valid order block. This sets up a strong likelihood that price will dip below this liquidity zone, fill the gap, and then continue its upward move after tapping into the second order block. Here's another example. You could have selected either of these candles as valid order blocks. We've got a noticeable gap, a break of structure, and a significant amount of liquidity accumulated below these equal lows and this mitigated order block. Now, once price breaks below this higher low, some traders might interpret it as a change of character. But if we look to the left, there's a visible gap and a valid order block positioned exactly below that level. This increases the likelihood that the move is simply a liquidity grab, and we still consider the market to be in a bullish phase. Now check out this bearish example on the euro-dollar 1-hour time frame. We're clearly in a downtrend, and this order block stands out. It creates a clean inefficiency and a break of structure. But what makes this order block more interesting is that the beginning of the move includes a liquidity grab. That earns it a +1 point as a trading opportunity. However, here's a key takeaway. Every time you encounter a losing trade, it doesn't automatically mean there was a flaw in your analysis. No strategy is foolproof, because, ultimately, we don't have control over the market. The second factor to consider when trading order blocks is market volatility and spread. From our backtesting, we found that most winning trades occur during highly volatile days and sessions, typically the first and last days of the trading week. On low liquidity days, like the start or end of the week, the market tends to be quieter, which is why the majority of successful trades happen midweek. For pairs like the euro-dollar, it's best to trade during peak volatility times, such as the London and New York sessions. Otherwise, trading during low volatility periods doesn't make much sense, because we won't see the price movements necessary for effective setups. Another key factor in trading order blocks is managing the spread. Often, the market responds to order blocks with precision, within a single pip. So, if a trading pair has a high spread, you might end up missing solid trade entries or hitting your stop loss even when the actual price didn't reach that level. The third factor that impacts the effectiveness of order blocks is the market trend and how fresh the order blocks are. Order blocks tend to perform better in trending markets compared to ranging conditions. That's why it's more favorable to trade order blocks that align with the prevailing market direction. Additionally, focusing on newly formed order blocks is generally easier and yields better results. Take this euro-dollar example. When the market is clearly trending, notice how frequently it forms fresh order blocks, respects them with clean rejections, and then keeps driving in the same direction. On the flip side, check out this example. There's a valid order block zone, but before price even touches it, the market has formed multiple demand zones and broken through them to the downside. Some traders may view these breaks as liquidity grabs and place buy positions at the order block, but the reality is that supply has already taken control, so entering this trade without any confirmation wouldn't be a reliable move. That's exactly why confirmation on lower time frames becomes the third critical factor when trading order blocks. These confirmations help filter out many avoidable losses when the market chooses to disregard certain order blocks. Plus, having a reliable entry trigger as confirmation in our trading toolkit allows us to approach trades with greater confidence. The strategy of trading order blocks isn't confined to a specific time frame. However, once we identify order blocks on a higher time frame, we shift 2 time frames lower to search for confirmations and entry setups. For example, when we use the 4H, 1H, and 15-minute charts as our higher time frames, we look for entry signals on the 15-minute, 5-minute, and 1-minute charts accordingly. A variety of price action patterns can be used to confirm trades based on order blocks. Here are some of the most commonly used patterns in our trading approach. In the first step, we wait for the market to mitigate our higher time frame order block and observe how price action unfolds. The first key signal we're looking for is a change of character, CHO. This indicates the short-term downtrend may be over and that price could start moving upward. Once the market shows a change of character, that's our cue to start looking for an entry. Typically, we see 2 common entry patterns. In the first one, the change of character move creates inefficiency and a valid order block. We then place our order a spread size above the order block, with our stop loss set a few pips below the lowest point of the zone. For profit taking, we use a simple, stress-free technique to capture high risk to reward trades. If the price moves in our favor and starts trending upward, we trail our stop loss by placing it below each newly formed higher low. This allows us to lock in profits and let the trade run until it hits a higher time frame supply zone, where we then close the trade. The second pattern plays out when we have a change of character, CHO-CH, but no visible inefficiency or gap between the candles. In this case, we rely on Fibonacci retracement levels to set up the trade. We pull the retracement tool from the beginning to the end of the change of character move and place a buy order between the 0.618 and 0.786 levels. Our stop loss goes a few pips below the swing low, and we target the next significant structure level ahead of the price. Keep in mind, these setups aren't tied to any specific time frame or currency pair. You still need to backtest and figure out which pairs respond best to this strategy. If you found value in this guide, drop a like to show your support and subscribe if you're new here. Thanks for watching, and we'll catch you in the next episode.